Alright everyone, welcome to the channel. In today's episode, I'm going to be updating my educational playlist with the episode that I would like to call Blank to Bank Analysis. Within this video, I'm going to show you how I go about charting. I'm going to show you my process and processes of looking at a chart, taking it from A to B. I'm going to be showing you to start with how I do this in the macro time frame, and then I'm going to be going on into the lower time frames to the latter half of this video, and I'm going to be showing you how I look at lower time frames such as this chart over here on Solana. So let's jump right into the video. To make this super simple, let's go through everything together. I'm going to remove all the drawings, I'm going to remove all of the indicators, and we're going to start off from, like I said, this blank chart, and we're going to make it into something good. Now, first of all, like I said, the first part of this video is the higher time frame. So we need to distinguish how high of a time frame are we in at this moment in time. Specifically, what I'm looking at is this BTC USD chart, and if you notice, if you're looking at the weekly time frame, monthly time frame, and you're looking at a chart that experiences parabolic growth, you'll need to decide whether you want to use a logarithmic scale or a regular scale. Within this specific chart, I think it's best if we look at this within a logarithmic growth curve scale, because Bitcoin is exponentially growing over time. As you can see, cycle bottom to cycle bottom, cycle bottom to cycle bottom, it's exponentially growing. So putting this on a log scale will put a higher level of distribution in the lower tail of the data, and subsequently we'll be able to see the macro chart a lot easier. If you're looking at something, for example, like Solana, which has not been around for a crazy period of time, putting this on a logarithmic growth curve scale can be useful. I personally would not recommend it. This is just how I do my data. There is no right or wrong answer. If you really like the logarithmic scale, then so be it. For this, like I said, I'm going to put this on a logarithmic growth curve scale. Now, the first thing you'll want to do is on the higher time frames, you'll want to decide, when did this trend start? Now, in my opinion, there's only two right answers to this. Number one, this is from the lows all the way down here, or number two, it's from the lows down here. Now, why are both answers right, and why can you argue both points? Number one, this massive drop that we experienced over here was from something called a black swan event. This is when a bunch of fear, uncertainty, and doubt comes into the market, and market sentiment seems to change. However, when you're looking at higher time frames, you are basically accounting for shifts in market sentiment. So in my opinion, I would personally draw the start of the trend from down here, but some people might say, you know, because this was a black swan event, because we massively cascaded, because of the fear, because of the market sentiment shifting into one of bearishness, that they would draw from the bottom here. And like I said, this is completely down to you, which one you draw from. They would personally both be valid. And what I'd recommend is looking at how the higher time frames react to these Fibonacci. So for example, with this Fibonacci from this low to this high, you can see the price went up and it perfectly backtested the 618. Came back up, made a new high, came down, perfect backtest of the 618, bounced up, perfect backtest of the 382, came down, bounced back up for another perfect retest of the 618, and now it's moving down to the 786. So right off the bat, we're able to look at this chart and we're able to see that these 618 Fibonacci's were perfectly respected. So let's do the same thing with the other Fibonacci level and see how it respects the fibs when we come down to this level. Now, what you'll notice is from the previous trend, we did come down to the 618 in terms of the candle body closes, but when we draw it down to this level here, the candle wicks actually perfectly came down to the 618. However, on these bounces back up, you didn't respect the 382 as much, and when you broke down, you bounced on the 618 and then capitulated below it. So like I said, within both of these examples, they're both 100% valid. However, in my humble opinion, I would move it to this Fibonacci. As you can see, a very clear trend reversal back down to the 618, confirming the trend as still bullish. You come back up, make a new high, almost a perfect backtest of the 618, perfect rejection from the 382. You slip below the 618 and confirm it as resistance, which is normally a textbook 618 Fibonacci trend shift. Once you break below the 618 and confirm it as resistance, then you're basically confirming the trend as bearish. This is not what we did over on this time frame. So in my, once again, humble opinion, This is how I would draw our macro fib. The second thing that you would want to do, which by the way, if you do watch my channel, you would know I am really not the biggest fan of trend lines. I much prefer moving averages. I much prefer Fibonacci levels. The problem with trend lines is they can be broken so many different times, and you could say, oh, it's broken now, so it's now bullish. For example, if we look back here, you'll see this trend line here. You might have said, we've finally broken out, we're going bullish. We just came right back down. And then you might have said, okay, we've got a new trend line now. So once we break out of this, we'll be bullish, right? What do? We broke above it, we back tested it, we flipped it, we're going to the moon, right? No, we absolutely capitulated. So I would really like to emphasize that I do not believe trend lines are at all the end all or be all, and you need to take them with the largest grain of salt in the kitchen. With that being said, you can see a very, very basic best line of fit from the lines down here, touch points here, plethora of touch points down here, plethora of touch points down here. Now you can line this up a little bit more, and you can technically draw it from these touch points up to these touch points. I much prefer when you've got an uptrending level of support which is respected, because you can actually see with this macro trend line, as soon as you broke below it, this was when the trend was shifting bearish. So if you are looking at a trend line like this, based on the trend line alone, this would have been the area to flip bearish. But like I said, I can't emphasize this enough. Trend lines are just magical lines in the sand that mean absolutely nothing. Fibonacci's, I definitely recommend to do research on Fibonacci's. Fibonacci's are seen from everywhere, from mathematics, nature, patterns in trees, patterns in fossils. You know, Fibonacci's, they constitute almost everything in the entire world. The Fibonacci sequence is basically, it encompasses so many different things. So when you look at the Fibonacci levels in terms of trading, these are psychological levels. Even if people don't look at the trend, or people don't trade based on Fibonacci's, you know, if we come down to the 618 and have a bounce, then, you know, you can clearly see the trend is bullish even if we didn't draw the Fibonacci. So that being said, you can see this would be a green line of support. What you could have done is mark it as green while we were above it, and as we capitulate below it, mark it red as resistance. With that being said, we've capitulated below it now. I'm going to mark it as a different color because in my opinion, this wouldn't really be a resistance line if we drew this all the way out to here. You can clearly see if we go into a bear market, you know, this resistance at 400, 500k is really not going to be valid. So I'm just going to mark it black as invalid. Second thing you can do is get a horizontal ray and slap it over the top of this market structure here. Now, with all the tools that I'm using, you will find the trend lines within this line here. If you want to find the Fibonacci's, click on these three lines and find the fib retracement. If you want the paintbrush tool, click on the paintbrush and look at the brush. The rectangle is also a great range that you can use. For example, if we click on the rectangle, this is great for when you don't necessarily have perfect trend lines. Like if we look at here, we can get a trend line from this low and we can extrapolate it over here. But what you will notice is there's another trend line sitting around about this valuation where we've got a ton of touch points around here. If you line it up, we've got a ton of touch points around here as well. But what you can do instead is you can delete these, you can get a rectangle and you can place it over the grid and you can encompass those lows. So you can really see, you know, this was the trend that Bitcoin was holding on. If we put the horizontal ray right here, you know, this was obviously red now because we've broken below it. We came back to this multiple times, and once you finally did capitulate below this rectangle, boom, massive move to the downside. So rectangles are great for large support and resistance ranges. You can mark this as green. Obviously we've broken below this now. This would have been green while we were above it, but now it is resistance, so we can mark this as red. What else do we need? So we don't have any moving averages, which is a problem. So what you want to do is you want to go over to indicators up here, and you simply want to type in moving average. You want to click on this, and in my opinion, as we're looking at this in the higher time frames, we shouldn't yet worry too much about the lower time frame fibs. So what I'm going to do is I'm going to go over to inputs. I'm going to change this chart time frame over to the weekly time frame, and I'm going to type in 200. This would constitute the 200-week moving average, which is a macro trend line. What we're going to do, because this is kind of small and dainty, we're going to click on this cogwheel. We're going to click on style. I don't really like the color blue. We'll mark this as orange because I'm a Bitcoiner. We'll click this as the highest level of thickness, and then simply click out of it, and you can see we have the 200-week moving average. Why is this such a good macro level of support? Well, you can see bear market down here, candle body close. The capitulation candle body closes over in the pandemic scare of 2020, candle body close. what we're coming down right now to? Candle body close. So when we are looking at these ranges as well, what you will also notice is we have a 786 Fibonacci right at this level. Now, personally, all down to preference, but I personally like putting horizontal rays and marking them as orange. That way I can distinguish whether a trend line like this, which is red, is resistance. If we had, you know, say for example, the previous all-time high down here, what we can do is we can put horizontal ray, we can mark this as green. So without looking at any of the data points, you know, I could zoom in here and we don't have to look at where the fibs are anymore. I can tell you this is resistance, this is resistance, this is orange, so this is a Fibonacci, and this is green, so this is a big level of support. And once again, you can zoom out and verify this yourself. Now, once we have got our first moving average in, I think it's good to look at a range of moving averages. So as such, you want to come over to the indicators once again, and this is where I really like the EMA ribbons. Now you want to type in EMA ribbons or EMA ribbon, and this top one is the one I recommend. Now you can try these all out. There is no wrong answer for this. You can get ones with Bollinger Bands, you can get ones with specific EMA ribbons, or you can click on this one and you can do some editing yourself. So for example, if we come over to the EMA ribbons right here, you'll notice we have a range of moving averages. Now, what I like to do is distinguish between the short and the long-term moving average. So the 21 EMA and the 55 EMA are the short and long-term moving average. You also do have the 200 EMA, which is the longest term moving average, which is always trailing below or above, depending on, you know, how bearish or bullish the trend is. It's normally miles away from the EMA ribbons. So bear in mind the 55 and the 21 EMA are the short and long-term moving averages within the ribbon. Because of this, I want these to stick out the most. So I'm going to click on these. I'm going to mark these with 3 times the amount of thickness as the other ones. So we're going to click on these ones right here. And as such, you can see you can also remove the 200 EMA, which is this yellow line down here if you don't want it. I'm going to keep it as it is. But now you can very much clearly see when we've got these big, you can very much distinguish between the short and the long-term moving average on the EMA ribbons, and as such, it makes it a lot easier to see whether we have a bullish or bearish cross over on the EMA ribbons. For example, you can see a ton of thin moving averages in here, but you can see this thick green line coming down to this thick green line as well. Once the short-term moving average crosses below the long-term moving average, you can see these 2 thick lines, then it becomes red, because short-term moving average below long-term moving average means that we're bearish. If you want to learn more about how to draw Fibonacci's, all of that good stuff, if you want to learn more about how to use these EMA ribbons, then I have an educational playlist for this very reason. This is my 20th video in there. I will teach you everything from Fibonacci's, moving averages, how to plot, how to distinguish between bull trends and bear trends. I'll teach you a range of different things. So if you do want to go check out the educational playlist, then be sure to go check it out. Another thing that I have in the educational playlist is Elliott wave theory. Now, if you are looking at these higher time frames, you might also want to see what does the Elliott wave theory say about this. Now, if we look down here, what you'll notice is as we topped out in the previous all-time high, we had a typical Elliott wave A, B, C correction. Now, this might be a bit foreign to you if you have never heard of Elliott wave theory. It would take me way too long to explain Elliott wave theory in this video. So if you do want to learn Elliott wave theory, be sure to also check out the educational playlist. But what you'll notice is we've got an A, B, C correction. This is the start of a new trend. You've got your 1, 2, 3, 4, 5. And as that tops out, you would be entering a macro A, B, C correction. And subsequently, you can see A, B, and just based on this Elliott wave theory alone, we now know that we are in the last leg to the downside. Now, with Elliott wave theory, typically we bottom between the 1 wave and the 3 wave. We're below the 3 wave, so let's mark the 1 wave. Let's mark this as green, as support once again. So we know that according to Elliott wave theory in this macro chart, 14,000, this level right here, should be the level to hold. Now, this is all good and such. You can see if we look at the Fibonacci's, you're below the 618, so you know that the trend is macro bearish. That is what being below the 618 means. We're going to mark this as orange as resistance. We can also see, looking at your EMA ribbons, that we are in a weekly downtrend on the EMAs. Now, Another thing to distinguish between bullish and bearish trends is specifically bullish and bearish momentum. For this, we're going to be using my favorite momentum indicator of choice, which is the squeeze mom. A lot of people like to use the MACD. You can use either or you can use both. It's completely up to you. For this, you simply want to go into search once again and type in squeeze momentum indicator. Now, I do recommend favoriting these if you're new to TradingView as well. So once you simply favorite that, you can click back on indicators and you'll find your list of favorite indicators here. You can click on the squeeze bomb, and now we have our momentum indicator of choice plotted on this chart. Now, with the squeeze bomb, you can see the squeeze bomb moves in waves. It's very cyclical. It moves from bullish cycles to bearish cycles. Now you can see when we're pushing up into the light green, this means we're in a bullish wave. When we're pushing down into light red, bearish. Light green, bullish, light red, bearish. And between these phases, you turn into either dark green or dark red, which is an indicator that you're either losing momentum or you're taking a break. Now, within this trend, you can see dark green into light red means that you've now switched over into a bearish trend. Dark red into light green means you've switched over into a bullish trend. Dark green into light red, bearish trend. And what you can see here is we've actually gone into dark red, which means that you're either flipping into bullish or you're taking a break, but now we're trickling back over into light red, which is indicative that you are not having a bearish momentum reset, or whether you were switching from a bearish trend to a bullish trend. It simply means that you are now reaccumulating bearish momentum back to the downside. So based on this, we can see our Fibonacci say we're below the 618, so we're bearish. On the Elliott wave count, we're in an A, B, and we're finally in the C impulse. So typically, looking at this chart, we should bottom before the one wave, which is here at 14,000. Looking at the squeeze bomb, we're trickling over into the light red. So this means that even though we are very, very close to this one wave, we still have a lot of bearish momentum. And at this moment in time, we should expect lower price targets. When we look at the macro moving averages, you can see this 200-week moving average. You can also use the 100 and 300. They are all good. For example, if we go over to this moving average and we type in 300, you can see we never really break below the 300. Well, if we extrapolate this a tiny bit further back, this would have perfectly held. Obviously, the 300-week moving average takes in data points from 300 weeks worth of data. So if your coin has been trading for less than 300 weeks, you're not going to be able to use that. If your coin has been trading for less than 200 weeks, you won't be able to use the 200-week moving average. So, for example, if you've got a new altcoin and it's only been trading for 10 weeks, then you would not be able to use a moving average longer than the 10-week moving average, and as such, you should probably use a lower time frame moving average. We can tell looking at these support and resistance zones that this was the last line of support, this big red box, and we've capitulated below it. So we are obviously in a bearish trend based on these indicators over here. We can also go over to this here and we can click on arrows, so we can remind ourselves of the general direction of the trend. We can also go over to the paintbrush over here, just like we did with the rectangle, and for example, we could, circle the 1 wave, the 3 wave, and the 5 wave, and we can circle the A, B, C correction. You can do all types of different things with this. I'm just going to leave it as it is. Now, one last thing before we do move over to the short-term charts is if you are looking at these higher time frames, it's definitely worth looking at a couple of oscillators. My favorites are the money flow index and the RSI, the relative strength index. Now, the relative strength index on the weekly time frame for these macro charts are very, very powerful. Let me show you why. If we look back at the 2017-2018 bear market and we simply draw a trend line coming down on the relative strength index, you can see, when did the weekly RSI break out? It broke out on the 28th of January. What was the price action doing on the 28th of January? It was sitting at around about $3,400, and where was the exact bottom? $3,150. So while this is by no means an indicator to buy the exact bottom, it's a great indicator to look at to kind of quantify whereabouts are we in the market. For example, if you're sitting at over 70, you know that you are currently overbought. If you're sitting at or below 30, you know you're oversold. So Let's look at what the RSI is doing right now. Well, as you can see, we're currently sitting at 28, which means that the relative strength index is very, very oversold. Now, if we just draw a line of best fit so we can encompass these 2 touch points, in fact, these 3 macro touch points, you can very much see, according to the relative strength index, the bottom is not in whatsoever at this moment in time. We are massively moving down on the RSI. Let's try one more, and then we're going to move over into the lower time frame. So let's try the money flow indicator, or the money flow index. So if we look at this once again, let's draw a line of best fit, or you can draw something like this. I'm just going to draw it as a line of best fit. You can very much see that, the downtrend is still very much in play on the money flow. If we look back at previous cycles, from this top down to here, you can see, when did the money flow broke out? The money flow broke out on the 17th, which definitely did not correlate to the exact bottom. So the money flow is definitely a slightly stickier one. I would not take the money flow indicator to the bank, and as such, I would definitely recommend looking at pairing the relative strength index on the weekly time frame, pair that with the squeeze momentum indicator, so you can have a good idea of what the bullish or the bearish trend is saying at this moment in time. To finish things off, we're going to type in volume. With this volume, you'll see all of these candles coming on at the bottom of our chart, and very, very simply, I'm sure most of you know what volume is. It's just how much price action was either bought or sold on a particular candle. So we're looking at the weekly time frame. If we look at this one down here, if you put your cursor over the volume, what you actually notice is this volume to the top left of your screen will change numbers. So you can see that this says 67,000 over here. So what does that mean? It's currently Monday as of the time of recording this, and this is on the weekly time frame. So specifically, we know that on today and so far in this week, we've got 67,000 traded. Now, this is going to increase, definitely. It's obviously going to increase. This is only Monday. It's not like nobody's going to be trading for the rest of the week, so you can imagine that is going to go up over time. One final thing you can do is go to Heikin-Ashi candles. Now, if we remove the drawings temporarily, you will come over to the top left and go over to the bar style, and you can come over to the Heikin-Ashis. Now, I'm not going to fully explain how Heikin-Ashis are calculated and how they're used. I have another educational video showing you exactly what to do with Heikin-Ashi candles, how they're calculated, how to trade them, but what you should know based on this video alone is Heikin-Ashi candles are great at characterizing uptrends and downtrends because they predominantly open at approximately halfway through the previous candle body close. It's a little bit more complicated than that because they do also encompass the lows and the highs of the wicks. However, as a general rule of thumb, you can assume that it is going to open at the approximate value of halfway between the previous candle, and as such, it would take a lot more momentum to the upside while you're in a downtrend to push into a green phase, and it would take a lot more momentum to the upside when you're in a downwards trend to make it turn into a green candle. So why do we use this? It's harder to make a trend shift bullish or bearish, and as such, when you look at the trends, you can see these very, very clear-cut green, red, green, red, green, red cycles, whereas you switch over to the Japanese and you can see a plethora of fake outs on both the green and the red candlesticks. So let's hop into the lower time frames. Alright, now let's jump into how I chart on the lower time frames. For this, we're going to be switching things up. I'm going to move over to a fresh chart, and instead of quantifying Bitcoin, we'll be looking at what Solana is doing against the US dollar in the short term. Now, bear in mind, probably by the time you're watching this, the price of this is going to be completely different. So when I do make my prediction on what is going to be happening in the short term, bear in mind, if you're watching this in a couple of years' time, the price might be 100 times higher, or it might be 100 times cheaper. This is really for the short term, and obviously when I say my short-term price prediction, it's not going to be there in a couple of months. So let's jump right into the video. First of all, we're going to be looking at Sol USD and Sol BTC. Now, it's very important if you're charting altcoins that you not only look at how they're performing against the US dollar, so type in Sol USD, add that, but also to see how they're working against Bitcoin. So simply type in Sol BTC, and you'll have a couple of BTC pairs, and then load that up on a separate chart. So let's jump right into this. For this, I'm going to start off on the daily time frame. We're going to keep our squeeze mom. We're going to keep our EMA ribbons. I'm just going to temporarily hide the EMA ribbons now, just like we did on the higher time frames where we looked for the start of a trend and we drew it to the top. What we're going to be doing is we're going to be zooming into the lower time frames. Like specifically, I want to focus on this section, and we're going to be looking from fibs that we can draw from the low to the high. So you can see down here we had a low. I'm going to draw it from where we back tested, and we've got a fib from the low to the high. And as you can see, we perfectly came down to the 1.618. So we know right off the back, we back tested it, came down, back tested it again, and as we capitulated below it, that is when the massive landslide came in. So right off the bat, we know this fib is well respected. Let's go over to the next fib, because we also have a fib from this low right here up to this high. So once again, right off the bat, our slightly higher time frame fib, we've got the 1.618 right here. What you will notice is the price target for the 2.618 is actually in the minuses. So you would basically know that obviously that target is not going to be coming into fruition. None of these are going to go into the minus targets. But what we do have on the lower time frames is a lower price target down here at $24. So right off the back, we could very much say that $24 would be coming into play. Now, one other thing, even if you are looking at the lower time frames, it's definitely important to look at areas like previous all-time highs, like you can see here. And it's also definitely important that you do have these macro fibs set up, even if you're looking at lower time frames, because now we've drawn the macro fib. You can see your macro 786 was all the way up here. As we're below it, we know that we're bearish, so we only need to focus on the lower time frames. You can see we've got a massive increase in volume. Volume is predictive of price, so we know that based on the direction of the trend, looking at our EMA ribbons as well, we're below the daily EMA ribbons. Looking at the squeeze bomb, we're having a bearish shift into the light red. So based on all these indicators, we know that we are very likely to go down. Now, we need a short-term moving average because, you know, based on the 200-week moving average, this chart, like we said, not all of these altcoin charts will even have 200-week moving averages because this has not been trading for 200 weeks. So what we're going to be doing is we're going to be switching this over to the 13-day EMA, and because we're now looking at the lower time frames, I'm not going to have this as thick as before, because if we zoom in, this is just going to be so big and such an eyesore. So we'll make this 2-player, so this is 2 times bigger than the average size. Click OK. And now we can zoom in and you can see what is the price action doing. Well, we flipped below the 13 EMA at $105, and since then we've been coming crashing into the 13, crashing. So the 13 EMA is such a beautiful signal. And on the flip side, you can see once you do flip it, you can go on these big pumps. Well, this wasn't too big, but you know what I mean. And one other thing I would like to specify about the 13 EMA is it is useless when you're trending sideways. So for example, within this phase over here, it's completely useless. The 13 EMA is perfect when you're in an uptrend or a downtrend. It will show you when you have a trend shift from that uptrend or the downtrend. But when you trade sideways, you'll see fake out. Well, this one actually ended up coming into fruition, but once again, when you're trending sideways, these mean absolutely nothing. When you're trending up, like you are here, you've got a big run up, you can see as soon as you flip below it, that is when you become bearish. You break down, come back up, back test it, break down, back test it, break down, back test it, and then you have a massive cascade to the downside. So once again, 13 EMA is a great short-term moving average. Now, we can also put trend lines on this lower time frame, but one thing I would like to say as well is right here at this level, let's mark this as red for resistance. I'm noticing now, pulling out the brush tool, that we've got a big M pattern playing out on this chart. So what we can do is we can get a price target from the top of the M pattern, we can drag it down to the bottom, and as you can see, the price target of this M pattern will be coming into correlation with the 1.618. So at least from the analysis we've done so far, the price seems to want to come down to between the ranges of $24 and $23. Once again, when we zoom out, because you really should pair these macro charts with the micro charts, let's look for previous macro support, and then we'll put horizontal rays. Like there's support here, there's support here, there is support, there's a big box of support here, so we'll mark this as a box, and we'll drag this over. We'll mark it green in a moment so we know that as we are above it at this moment in time, this is going to be an area of support. Mark this red line as green, support, red line, green, support. So right off the bat, once we do zoom back into the lower time frames, we can very much see once again we now have a bunch of areas where we're likely to come down to. The M pattern breakdown, first of all, is going to come down to the 1.618 at $24 to $23. Based on the price gap that we've got, you know, we're going to head into the much lower time frames in a second, but on the next level down from here is about $18, and the next level down from that is $12, next level down $10, next level down $7.50. So right off the bat, we have a list of targets where if we do break down from 24, we'd head down to here, then head down to here, etc. Now, let's head over into the 4-hourly time frame. What you'll notice is on the 4-hourly EMA ribbons, you're getting absolutely battered. You're getting slaughtered. So if we zoom out, you can see, if you want to go back on something, there's two things you can do. So this is a perfect example. You can click the undo tool on the top left up here, or let's move it again. What you can do is on your keyboard, click Control Z, and as you heard me just press that key, it moved back. Now, if you want to move it back to where it was, you can also click Control X, or Control, let's move it back, Control X, and it will delete it. Or once again, if you want to add it back, you can go like this, Control Z, and once again, bada bing, bada boom, you have your Fibonacci in the right place again. So let's look at this. We got a rejection, or rather we had a bearish momentum shift over on the EMA ribbons at $123. We did try and break above them, but you pushed above, back tested them, M'd out and broke down. So you can pretty much tell that that was obviously a fake out. So since this level at $122, we can see the trend is your friend. You come into the EMA ribbons, rejection, 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 and as you can see, the trend is very much defined by the EMA ribbons. So we know that until, at least on the 4-hourly time frame, we're bearish on the 4-hour, until you do hypothetically cross above this line. So let's say we do something like this, we know that we might be magnetized to this floor, because as you can see, there's a big area of resistance up here. So we might come up to this level before we come back down, and then we might start to push back up again. You can also see the 13 EMA would start to converge. So this intersection here would really be the price to beat. So based on this data that we've got running here, let me mark this as blue. So this looks like the continuation of the 13 EMA. You can see once you pump above the EMA ribbons, which would be converging down to the levels of $35, let's mark that as, once again, red, so we can tell that this is, the bearish line from your EMA ribbons. You can tell once you hop above these, hop above the 13 EMA, come down and back test this region here, which is $34. If you do start to head up, and very, very importantly, you need to take out the invalidation point. So if you did pump up to this level specifically, you are technically not bullish until you get rejected from it, back test, and then start to push up to the upside. Until that happens, like I said, you would absolutely not be bullish. So in the lower time frames, we know the price to beat. We've got a good idea of some big levels that we might be coming down to, but on the flip side, if we were to have a move back to the upside, where would we be looking at coming from? So what you can do now is, now we have had a local bottom down here, at least in the past day or so. What you can do is you can draw your Fibonacci, you can draw it from the top of this trend up here, and you can drag it down to the lows. So based on this Fibonacci alone, it's slightly hard to see. So let me clear the chart just temporarily for you. If you see this from the low to the high, you would have your 786 up here. This would be a massive level to get above. You've got 618 up here and your 0.5 up here. So you really wouldn't be bullish, even in the micro time frames, until you start pushing above at least the 0.5 at $85, which is a long way away. However, like I said, you can trade it up to those levels. For example, you can wait for the flip and then you can watch it come up to here. And then if you do have a pretty sizable rejection, this would be like an area to take profits before you probably expect the price to once again be magnetized to the downside. Let's bring back our previous chart and let's mark your 618 fib, which is right up here. Let's mark this as orange, so you know that this is a massive level of resistance. The 618 is the most important fib up here at $98. Let's look at the 4-hour again and see if we've got any other micro fibs. So when we're doing these micro fibs, we've already got this low to this high. We want to look at a much smaller time frame to give us an idea of when we could be coming down. Now for this, it's probably better to go over to the 1 hour and identify a low like right here. You can see this low all the way up to this high. If we do zoom down, you can see 1.618 wasn't too well respected, but during the time everything was dumping. So, you know, you really need to take these with a grain of salt, but nonetheless, you would also have a price target down here at the 2.618, which is at $20. And as $20 is a psychological level, you could almost draw up this box. So if we zoom back out and move this box up, we could really encompass this big range over here, where we've also got, you know, this Fibonacci down here at $20, and then if we do break below there, we've got a massive range of support down to about $12. Now, that is basically everything in the lower time frames. You can also see what we're looking at right now is the squeeze bomb on the 4-hourly time frames ticking over into dark green, indicative that lower time frames we're probably about to have a move back up to the EMA ribbons. For example, if we look here, the last time we started to trickle over into dark red, trickle over into dark red, trickle over into dark red, all of these 3 times correlate to a dead cat bounce where you got rejected from the EMA ribbon. So it's very important that when you are looking at these lower time frames, you recognize that yes, we might be coming back up bullish, or bears might be losing momentum, but if you hop over to the higher time frames like the daily, you can actually see we haven't trickled over into dark green, or sorry, dark red, which is indicative that bears are losing control. If we look at it on the daily, you can actually see, you know, tons of bearish volume is coming in. We're moving miles away from all of our support and resistance zones, and you know, once again, the squeeze one is heading very heavily down into that light red intersection, which on higher time frames means that you are super bearish. Head over to the weekly. You can also see it's trickling over into the light red. So while the lower time frames, which is what we're focusing on here, the lower time frames like the 4-hour say we're likely to come up to these regions around about $34 before we have a move down. The higher time frames say no, you're going to have a dead cat bounce and then we're going to smack you to the downside. So if you hop over to the hourly EMA ribbons now, or the hourly time frame, I would really like to advise caution when trading on the hourly time frame. I know that I'm talking about the short term, and I know a lot of traders like using 15-minute, 10-minute, you know, 5-minute, 1-minute candles. And honestly, when I do my TA on YouTube, I'll make a macro prediction and I'll say, you know, this is Ethereum, it's at $1,000, it's coming down to $500. You know, people will watch it go from $1,000 down to $750, and then it will pump up to 780, and they'll be like, is it time to reverse? Is it time to go to the moon yet? And it's just like, you know, these are lower time frames. Like, you're not going to go down in a straight line. Obviously, you're going to have these bounces between bullish and bearish waves, especially on the 1 hour. So if you are trading on the 1 hour, the first thing I'd say is don't even look at the EMA ribbons, because why would we not look at the EMA ribbons? Well, look at this. We were trending sideways, and you can see fake out, 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 and then this was the actual big move to the downside. You know, the whole time we were going bullish, bearish, bullish, bearish, bullish, bearish. We were literally just trending sideways, within this massive range. Now, as we believe the price is going to be magnetized to the downside, you need to take, you need to kind of use your intuition as well. So, for example, just looking at Sol USD is not going to give you the greatest indication of whether we are coming down to these lower time frames. You should also look at Sol BTC. So you should try and look at how the BTC pair is doing. This is a chart that I've booted up in the lower time frames from the low to the high. You can see we've come down to the 1.618. We've bounced on it, so we know this is respected. The next line in the sand is this macro bottom all the way back here. So in my opinion, from where we are at this moment in time, we should expect about a 43% drop on the Solana BTC price. But what I'd like to say is, if you are trading altcoins, if you're trading Solana specifically, then look at how Bitcoin is doing. This is probably the wrong chart to choose from. There's a lot going on here. Look at what Bitcoin is doing. Once again, this is probably the wrong chart to use. Third time's the charm. Look at what Bitcoin is doing, because if you can see Bitcoin going on a massive cascade like it is at this moment in time, this gives you a good indication of what the altcoins are likely to do. And if Bitcoin has not finished doing its dump, then Solana has probably not finished doing its dump. And if we head over to the 4-hourly time frame, Bitcoin's having a bounce in the past 4 hours, Solana's having a bounce in the past 8 hours. You can see these are very, very highly correlated. So finally, at least in my opinion, I think the most likely, massive area of support is between this $20 and $12. Now, once again, you do have one target in the sand, one target in the sand, one target in the sand, one target in the sand. But as we've already had a bounce at this level, I don't think we'd be heading down to heading below 26 and then finding support at 24. I find it much more likely that we'd probably break below that level and then head down to another level. So right off the bat, I would say in the lower time frames, within the next day or two, maybe within the next 4 to 5 days, the next target down for Solana would be $20.80. So how would you trade this? Because at this moment in time we're bouncing, and you definitely don't want to do something like do a 10 or 20x leverage until you're sure that we are having this trend reversal. So what I'd do is, if you were to break bullish, you know what to look for. You'd need to flip these areas of support. And on the flip side, if we were about to break bearish, you'd have a pretty good short if we came up, collided with both of these EMAs, which are, the short-term, no, the long-term moving average on the EMA ribbon, which is the EMA ribbon, or the moving average right at the top of this EMA, and the 13 EMA. And you can see if we do start to come down from there, that would be where you'd look to enter your short. And from where we would be if you were shorting, you could see that would be about a 40% drop. You would also need to make sure you manage your risk to reward ratio. So for example, if you're doing a 10x leverage, then you would be liquidated if we moved up 10% above the price. So you need to look and say, okay, if we come up 10%, is there going to be any areas that we can get rejected from up here? Or could we potentially move up another 13%, come into this 618 and then get rejected? That is something that you need to decide for yourself. You need to manage your risk to reward ratio very, very well. And for this video specifically, I don't want to teach you how to leverage trade and all of that good stuff. Maybe that's something that I'll teach in the future. But right off the back, what I think is going to be happening in the lower time frames is something like this. So that is basically everything that I've got for how to trade these markets. Now, one tiny bit of alpha that I would like to share: if you're trading Bitcoin, if you're trading cryptos, if you're trading anything within the crypto market, you should look at the dollar and you should look at the stock market. I know, so boring. Why would we care about the dollar and the stock market? Well, the dollar is inversely correlated to crypto. So at this moment in time, you can see the dollar's on a massive run, and if it's inversely correlated to crypto, you should be waiting for this to dump before we enter our trades. So for example, the dollar is heading up and the stock market, the SPY, is heading down. These are both bearish indicators for crypto, and subsequently these give us a greater idea of the trend that these altcoins, and specifically Solana, because this is what we are charting, is going to go in. So once again, yes, we may have a dead cat bounce in the lower time frames, but it seems very, very clear that the trend is your friend. You're below EMA ribbons. You've got an increase in bearish volume. You've got an increase in bearish momentum on the 4-hourly, but most importantly on the daily, because this is what is going to matter the most. And when you pair all these things together, you can head over to higher time frames and you can use the knowledge that we've learned from the start of this video, looking at these higher time frames, to recognize that we're now bearish because we're below the macro 786. And we should be looking for something. We should be looking for much lower price targets at this moment in time, in my opinion. Now, also one last thing is, you can also see, go over to the higher time frames, and you can see there's a tiny bit of support down these wicks around here. So if we once again head over to the lower time frames, you can see the most amount of support that's going to be coming in on this box is probably going to be at the top between the 2.618 at $20.79 and the bottom of the top of this green box, that was a mouthful, at $19.14. So subsequently, if you drop below 19.14, the next leg down would probably be down to between 12 and 11.50, which are where these next price targets are. So I hope you enjoyed today's educational update, blank to bank analysis. Like I said, this is going to be the 20th installment of my educational series. So if you are interested in everything from using Heikin-Ashi candles, from learning EMA ribbons, calculating golden crosses, calculating death crosses, learning about bull market support bands, all of that good stuff, then go check out that series. That is for you. That's all I've got for you today. As always, not financial advice. Calway out. Peace.